This video will cover two distinct valuation concepts. First, we'll discuss and compute the value of preferred stock, and then we'll move on and discuss and compute price-earnings ratios and price-to-sales ratios. Now, let's jump into preferred stock. Holders of preferred stock are entitled to dividends before common stockholders. Preferred stock is often called a hybrid security, and here's why. So if you look at a balance sheet, you have assets, you have liabilities, and then you have equity here. And liabilities, you have bonds, and for equity, you have common stock. Preferred stock sits right here conceptually on the balance sheet. Not only conceptually, but it's usually where it's put on a balance sheet when you look at financial statements, right in this area. And the reason for that is it shares some elements of bonds, and it shares some elements of common stock. And so, well, how does that work? Well, preferred stock pays dividends. Since it pays dividends, it's kind of like a common stock. But those dividends are constant, and they're constant over the life of these preferred stock. And so the fact that it's constant means it's like a fixed income security, which is a bond, because the cash flows are fixed. The other thing you should keep in mind is that preferred stock never matures. And so since it never matures, it's again very much like a common stock. Now, the way to value preferred stock is relatively simple. In fact, it's one of the most simplest valuation models we have out there. And what we do is we take the dividend on preferred stock, DP, and divide it by a discount rate, RP. And we get the value of the preferred stock as VP. It's a perpetuity. A perpetuity meaning it lasts forever. And not only does it last forever, but notice there's no growth rate. So when we looked at the dividend discount model, for example, we had a G here. There's no G because G equals 0. So you just leave it out. The other thing to keep in mind is there's no DT here, P. So this would be the dividend preferred stock at time T. There's no T because T doesn't matter, because there's no growth and it doesn't change. The dividend doesn't change in the amount. And so there's no need to have a T there. The other thing to keep in mind is DP is fixed because it's a fixed percentage of the par value of the preferred stock. So if the preferred stock has a par value of $100 and the dividend yield on the preferred stock is 10%, you'd multiply the $100 times 0.10 and you'd get $10 for DP without a T, because that $10 will stay fixed for the life of the preferred stock. And so that's some basic ideas of the notation and the formula that you should keep in mind when you look at preferred stock. Now, before we actually do an example of preferred stock and valuing it, let's take a step back and talk more about dividends. The board of directors votes on dividends each quarter for common stock and preferred stock if the company has preferred stock outstanding. A lot of companies do not have preferred stock, so keep that in mind. If there's no preferred stock, it's not part of their capital structure, which means how much debt, how much equity, and how much preferred stock do you have. And how much of that is funding your balance sheet, your asset side of your balance sheet. The board of directors evaluates companies' earnings, cash flow, and forecasts of these items to determine whether or not they can pay a dividend this quarter and in the future. And in the future is important because most companies, when they pay a dividend, they pay a certain amount and they want to keep that dividend relatively fixed over time, and at least for common stock, to allow it to grow. With preferred stock, they want to pay a dividend, but they want to make sure that, when they issue the preferred stock, that they have the cash flow in the future to actually pay that dividend. That's important, because what you don't want to have is the company defaulting on dividends, or just not, and even the word defaulting is not the right word for it, because board of directors have the right to declare a dividend or not. If the company has sufficient cash flow and earnings, then it will declare a dividend. However, if the preferred stock dividend is not paid in full, common stockholders don't get paid until the preferred stockholders are paid first. With this understanding, let's do an example of valuing preferred stock. Recall, this is our model. This is our model for valuing preferred stock right here. And so what I'm going to give you is an example, and there's not much inputs here for this example. It's the dividend is $2 per share. And we're going to assume a discount rate of 9%. And so we want to value the preferred stock, and we get 2 divided by 0.09, and that's 22.22. So this preferred stock has a value of $22.22, and you're going to get $2 constant forever. The same $2, you're going to get it all the way to infinity. And the discount rate to bring everything back is 9%. It would be interesting to compare this preferred stock that goes out to infinity, to compare it to, say, preferred stock with a 50-year maturity. There is some preferred stock that have maturities, and the most common maturity period is 50 years. The duration of these bonds are outstanding for 50 years. So how would you value a preferred stock with a 50-year maturity? Well, let's take the same example. We have payment equals $2, and notice I'm going to start putting this into a financial calculator. The interest rate per year is 9%. The future value is 0. N equals 50. We're going to compute present value. The value of any financial asset is the present value of its future cash flows. When we do this, we get 21.92. Ooh, that's pretty darn close to this guy. So how do you explain that? Well, what it means is, looking at a timeline, and I'm going to put a little chop here, and this represents 50 years, and then this represents all the way out to infinity here. So what we're saying is, look, if you have a preferred stock that goes all the way to infinity, that's worth 22.22. And if we have a preferred stock that only goes out 50 years, it's worth 21.92. What that means is all of this, the present value of all the dividends in year 51, all the way to infinity, what is that worth right here? The difference between these two numbers, it's worth 30 cents. That's it. Wow. But that's what happens when you discount something by 9% for over 50 years or more, going all the way out. It's not worth very much. So nearly all of the value is within the first 50 years is another way to interpret that. So that's all I have to say about preferred stock. Now let's change gears and start valuing common stock using relative valuation methods, or what are called ratio methods. That's right. These are valuation methods. They don't look like valuation methods that we've used so far by discounting. There's generally no discounting going on here, although I will relate it to the dividend discount model a little bit later on. What are these valuation methods designed to do? Well, they're designed to show whether or not a stock is over or undervalued without actually computing the stock price. Although you could manipulate the algebra and back into a stock price. But let's present it as a ratio method for now. The relative valuation methods that I'm about to show you, or ratio methods as they're often called, are useful, for example, if a company pays no dividends. Some people are uncomfortable using the dividend discount model when the company doesn't pay dividends. It sounds kind of strange. Why am I valuing a stock with no dividends using the dividend discount model? Well, it turns out you actually can value a stock using the dividend discount model, even though the company pays no dividends. Well, you just assume that they're not going to pay any dividends now until maybe, let's throw out 5 years. And so D1 is 0, D2 is 0, D3 is 0, D4 is 0, D5 is 0, and then year 6, starting in year 6, the company starts paying a dividend. So D6 becomes a positive number, say 50 cents. D7 now is maybe 75 cents, and so on. So my point is, while some people are a little concerned about using the dividend discount model with stocks that pay no dividends today, the assumption you can use is that the company will eventually mature and its growth will slow and it'll start paying dividends. So what exactly are we going to look at here? We're going to look at the PE ratio, and we're going to look at the price to sales ratios. These are relative valuation methods, or obviously ratio methods, where we scale the price relative to fundamentals. And what are the fundamentals? It's what the underlying intrinsics of the company are. Things that drive the value of a business. Those are fundamentals. They would be the earnings of the company or the sales of the company. So we're taking price, say $10, and then dividing it by, say, earnings per share of 50 cents, and we're getting a 20 number. And that's often called a multiple because the stock price is 20 times its earnings, because earnings are the main driver of a stock price. In other words, because earnings are the source of cash flow for dividends. You could have a stock that's 20 times earnings, or you could have a stock where the stock price is 25 and it has 50 cents in earnings per share also on an annual basis, by the way. This is earnings per share on an annual basis. This company has a PE of 50. Woo! Look at the difference in that. The price here is 50 times the earnings per share. And so the price is high relative to the underlying fundamentals of the company. That's what we're saying here. So this would be considered, all else being equal, a much pricier stock, a much more expensive stock. And it could be overvalued relative to this company, which has a much lower price relative to the earnings per share. And so that's why we're talking about relative valuation methods, ratio methods. We're scaling the price by something fundamental about the company. And we can do the same thing with price to sales. And this would be sales per share, by the way, which you don't often hear, but it is an important component in financial analysis. So if we had a $10 price here and sales per share were $2, then we'd have a price to sales ratio of 5 times, which basically says, look, the price is 5 times the sales per share. And then if we had a $25 stock with a $2 sales per share, we'd get a $12.50 times price to sales ratio. And so again, using the same logic, this stock would be, all else being equal, overvalued relative to this stock. Now at this point you might ask, well, what's a high PE ratio for the market and what's a low PE ratio for the market on average? Well, if you look at the S&P 500 over the long run, ballpark, the PE ratio is averaged about 20, which means that's approximately the average stock's PE ratio. And in good times, it's above 20, and bad times, it's below 20. It can often get quite high when we're in a strong economy. The other thing you want to look for is look at the PE ratio of the stock itself over time. And you want to calculate the average PE ratio of a particular stock over time to see whether or not it's high or low compared to what has been in the past. That will give you an idea as to whether or not the stock is under or overvalued. There's even a third method that you might want to try, and that's to look at comparable stocks in the industry that the company is in to see whether or not the PE ratio of your particular company that you're examining is above or below other companies that are in the same industry. There you have it. 3 different ways to use a PE ratio to see if a stock is over or undervalued. 1, compare it to a market index like the S&P 500, which would represent the average stock. 2, compare it to the stock's own history of PE ratios to see if it's high or low compared to the past. And then 3, compare the stock to other stocks in the industry to see if the stock price is high or low using the PE ratio. Now let's backtrack a second. If you recall, a few minutes ago I said all else being equal when you look at PE ratios and compare them from company to company. And the reason why I said all else being equal is because often all else is not equal, because you're looking at stocks that have different levels of risk or different growth rates, and the differences can be substantial. When you make a comparison of PE ratios to the market average, to industry stocks, or even to the company itself over time, you need to make sure that the risk and the growth are comparable to the market average. It's about the same as it was in the past for the company's own stock, and is it about equal to the other companies in the industry? So now what I want to do is put a little more context to the model that I just presented, give you a little more detail so it makes more sense, by discussing applicability. Like, why would you use this and when would you use these models? First off, keep in mind that both dividends and sales represent cash flow. Dividends obviously much more direct for valuing a stock, but sales is a measure of cash flow also, so keep that in mind. So if you have a company that has negative earnings, then the price-earnings ratio is not going to be applicable. If it has no earnings, it has no dividends either, so the dividend discount model's out, the price-earnings ratio is out. Well, hopefully the company has some sales, in which case you can use the price-to-sales ratio as a backup. So there's a reason for these methods. Now, what else I want to talk about is, look, baked into these price-earnings ratios, and even the price-to-sales, but let's focus on the price-earnings ratio. Baked into those ratios is growth and risk. So you have to take those into consideration when you look at price-to-earnings ratios. You could have a very high price-earnings ratio, and it could be because the company has really high growth in the future for its dividends, or just the business in general, or it could mean it has very, very low risk. So what do I mean? Well, let's go and look at the dividend discount model again. So we said that an estimate of the stock price today is the dividend, next period, D1, divided by the discount rate minus the growth rate of dividends. Now, we can substitute out D1, dividends, for next year and put E1, which are the earnings next year, times the payout ratio next year. And you know, E times D1 divided by E1, well, that just cancels out to be dividends in dollars. So that's what this is, dividends in dollars here. So if we do that and we make the substitution, put it in here, and we divide both sides by E1 algebraically, we get an estimate of the stock price today divided by E1, earnings next year. And by the way, I should put a little caret here, and I should put a little caret here, because this is an estimate of earnings next year. We have to estimate next year's earnings. We don't really know for sure what they're going to be, so this is relying on an estimate. And what we're going to do is we're going to show that, look, the price-earnings ratio here equals the payout ratio divided by the discount rate minus the growth rate. Ooh, there's a measure of risk that impacts the price-earnings ratio. There's a measure of growth that impacts the price-earnings ratio. Now keep in mind, I'm using what's called a leading PE ratio. There's two types of PE ratios. Both of them use a price today, P subscript 0, the price right now. But this one uses the earnings per share for the last year. We can observe those earnings per share. So the earnings are backward looking, yet the price is forward looking because it's based on future cash flows and risk. This is kind of not quite a coherent measure of, not quite a consistent measure of a price-earnings ratio, because one item's looking forward and the other's looking back. It's kind of inconsistent. But it is used a whole lot in the real world because people can pretty much agree on what earnings per share is. Now I say pretty much agree because some analysts like to back out discontinued operations or special items that affect the financial statements, because special items and discontinued operations, they're not going to affect the future, so they back those out. And that could be somewhat subjective, but for the most part, earnings per share last year are observable. Now, that's called a lagging PE, but there's a leading PE, which is what I just used here. It's today's price divided by the estimate of earnings for the next period. As I said before, this is called a leading, or sometimes called a forward price earnings ratio. This is looking forward. Stock prices look forward to the future cash flows and risk. And this earnings is looking forward too, because it's next year's earnings. So, you want to draw a timeline. Here we are. And so this is next year's earnings. And last year, this is E subscript 0. So here we are to time 0 today. This is last year's earnings that we can observe. Now we have to come up with an estimate of earnings for the next year going forward. So the stock price looks forward, and so do earnings. So we got to measure a consistency there. But the point is, besides that, is look, I'm just showing you a price earnings ratio that's derived from a theoretically correct valuation method. I'm showing you the price earnings ratio is derived from a theoretically correct method of valuation, because the dividend discount model theoretically is correct because it captures all cash flows and accounts for risk. And so the price earnings ratio that we have here, the leading one, is consistent with theoretical valuation methods. And it's not just a thrown together ratio, is what I'm trying to say. We could do the same type of analysis to compute the fundamentals of price to sales, but I'm not going to show you that. That's getting too far astray. And so I just wanted you to know that, look, you can match this up with a theoretical model. Now, before we go, let's just do a quick estimate of the PE ratio using an example. So let's say the payout ratio, which is the dividends divided by earnings per share, is 40%. So the company pays 40% of its earnings out and retains 60%. Let's say RS, discount rate's 10%, and the growth rate of the stock is 5%. We want to estimate the value of the company. So we look at it this way. We have this is 0.4, this is 0.1, this is 0.05. And so what we see here is that this equals 8 times. So the PE ratio is 8. Well, if we know the PE ratio is 8, and let's say the stock price today is 25, we can always observe the stock price today, so that's always available. So we take 25 divided by E1 equals 8, and we solve for E1, and we get E1 equals 3,125, about $3.13 is the earnings per share estimate for next year. So you can put a little hat on there if you'd like. And from that, we can estimate what D1 will be, because D1 is going to be the 313 times the payout ratio of 40%, and that's going to be $1.25. So there's a good example here of how to use the dividend discount model, incorporate growth and risk. Now keep in mind, just like with the stock price, if growth goes up, since it's on the bottom with a negative sign, it's going to drive up the PE ratio. So high PE ratios could be because of growth. Or it could be because of low risk, which is on the bottom and it goes down. That means the price will go up. Or if you have a really low PE, you think, wow, that's a bargain stock. It's got to be a bargain stock. Well, it could be that the growth rate is really low. It's a dog. The company's not doing well. Or it could be the risk is really high. Both of those factors could account for a very low PE ratio. When you look at this, you say, wow, this is a really cheap stock price. It could be highly risky, or it could have very little growth prospects. So that concludes my discussion of relative valuation methods.